D&O, or Directors and Officers Liability Insurance, is a critical coverage part for most mid-market private firms. In this video, I'm going to discuss the unique attributes and considerations of D&O insurance for portfolio companies that are owned by private equity firms. Hi, I'm Gordon Coyle. Welcome to my channel where we talk about the risk and insurance issues on the minds of business owners. As an expert business insurance broker, these videos are intended to help guide and educate decision makers to help make you a more informed insurance buyer. If I don't answer the question on your mind that brought you to this video, reach out and let's connect. I'd love to hear from you. So, I think a good place to start in this discussion is with answering the basic question of what does D&O insurance cover and why is it important for privately held firms? D&O insurance protects the leaders of a privately owned company from claims which can arise alleging any number of wrongful acts in managing the company. Lawsuits can come from investors, competitors, employees, regulators, and others, and will often name the firm's decision makers personally for their acts, putting your directors and executives and other leaders' personal assets at risk. For private equity firms, there are three other unique elements to D&O that need to be clarified. First, the PE firm will have one or more of its partners or employees on the board of their portfolio firm, so making sure that they are properly protected for their actions is important. Second, the PE firm also wants to protect its investment in the portco's balance sheet. While the primary point of D&O is to protect the individual leaders, it also protects the entity, thereby providing peace of mind to their sponsor. Third, and this is common for all private firms, and that is D&O insurance provides peace of mind to any talented individuals you want to recruit to your portco's board. Often, independent directors will not sit on a portfolio's board unless they have sufficient D&O insurance. Now, from the sponsor's perspective, why should you want to be involved in the investee company's D&O insurance? I think the answer goes back to what I just discussed, and that is how critical D&O insurance is and what it protects, especially in the private equity world. I don't think you want to leave it up to chance and find out when it's too late that your portco has no D&O coverage, or it's inappropriate protection, or it's insufficient protection. There's too much at risk for you, your partners, and your investments. Your first line of defense is solid protection at the portfolio level. Okay, with that out of the way, let's look at how you can go about purchasing D&O insurance as the sponsor. Several years ago, especially when the D&O insurance marketplace was so difficult, master insurance programs were popular. Under a master program, the PE firm would negotiate a single policy to protect all the investee companies. The aggregation of premium provided some leverage in pricing and coverage terms, but this option is really not very popular today for several reasons, such as one portco may be difficult or expensive to insure than the others in the portfolio, so the other participants object to the extra cost put upon them. The allocation of premium costs are also impossible to get exactly right between the portcos. Aggregating isn't always very cost effective, and CFOs at the portco level often feel like they can do better on their own. Finally, when you're adding and taking off firms during the whole life cycle, it can be disruptive to that program. So now in a softer D&O market, the aggregation and master program idea is much less popular. Instead, a more popular idea is to work with a single broker and possibly one insurer to insure all of the portcos on separate policies, but with the understanding that the underwriter will provide preferential pricing through this exclusive arrangement, and a standard broadening endorsement is added to all the portcos policies. This method gives each portfolio their own policy, their own limits, and their own discounted premiums, and hopefully a streamlined underwriting and renewal process to make their life easier. Where this sometimes breaks down and becomes difficult is when a portfolio is comprised of very diverse companies with divergent underwriting characteristics, and no one insurer has an appetite to cover all the firms. In this situation, it may be more effective to work with just one broker who can negotiate with 2 or 3 different insurance companies to cover each of the portcos, with each insurer providing a standardized broadening endorsement and a commitment to provide preferential pricing. Now, with that said, there are smaller PE firms that don't exert as much control over the investee companies and don't want to get involved in this negotiation process. So what's the solution there? This is where I think it makes sense to work with a skilled broker like the Coyle Group to be a preferred provider to your portfolio companies, to provide them one-off solutions that fit their needs. In the smaller entity market, it is less effective to attempt to aggregate policies or negotiate programs since there is less leverage here, and better results can be had by working with a single skilled broker across your portfolio. The bottom line is that arranging solid D&O protection for your investee companies is critically important. If you're looking for a partner who can give you personal attention you deserve and the expertise to create a program of some sort, or just to provide one-off policies and advice, we're here to help support you and your portfolio. Give me a call or drop me an email. My contact info is in the description box below, and I'd love to hear from you and see how we can help. Thanks for watching.